Research reports on companies, industries, and sectors use a number of valuation metrics. The price to book ratio, the P ratio, price to sales, and the enterprise value to EBITDA are the most popular ones, as each of these metrics aim to convey a buy, sell, or hold story to existing and potential investors. For many of us, these ratios are a starting point, as we use them as a filter, combination, selection, or rejection criteria in our quest to discover cheap companies. In this video, we shall examine 4 commonly used valuation ratios, including what each of these ratios mean and measure, where does the formula come from, and the strengths and weaknesses of each metric. To better illustrate the points, we shall be using a number of real-life examples of companies like MRF, Hindalco, Bata, JK Tyre, Zomato, etc. So this is one video that you don't want to miss. Let's begin. The price to book value is the most widely used metric in the academic world, and very simply, it compares a company's market capitalization with its book value. Now, book value refers to the total amount of money a company can generate if the company were to be liquidated. In other words, it's the company's net worth. As a formula, a company's book value is the difference between the tangible net assets of the company and its liabilities. Alternatively, the book value can also be computed by subtracting the preference share capital from the shareholders' equity. This information on assets, liabilities, equity, and preferred stock can be easily found on the company's balance sheet. In fact, let's examine MRF Limited's latest balance sheet. There we go. So we have the total assets, the intangible assets, the liabilities. Okay, there is no preference share capital, and of course, there is the shareholders' equity. Now, there are 2 ways to compute book value, as we discussed earlier, but irrespective of the method one uses, the answer should be more or less similar. In MRF's case, the book value comes to 13,409 crores, which when divided by the number of issued equity shares gives us the book value per share. After that, it's just a matter of dividing the current market price per share by the book value per share, and we get the price to book ratio of the company. One of the big positives of the PB ratio is that it is a stock measure, which means it is not as volatile as the price earning ratio or a price to cash flow ratio. I think a good example of this is the Berkshire Hathaway stock, which continues to see big jumps in its P ratio, but not as much in its price to book ratio. So anyone who is looking to build a low turnover portfolio can explore using the PB ratio rather than any other ratio that uses a flowing measure. On the negative side, I have to say that the book value is one of the most hated ratios amongst investors. Okay, hated might be a bit harsh, but here are some problems that many investors put forward. Number 1, the book value does not take into account intangible assets, which is an important number for some companies. Secondly, book value keeps most assets at their acquisition value and not at their market price, which might keep valuations depressed. Thirdly, the PB ratio does not factor in essentials like profits, sales, and growth. And issue number 4 is that the book value even penalizes good capital allocation decisions at times. On this last point, let's assume a company which buys back shares. Now, generally, this move is thought to be good for the company's existing shareholders, but on the statistical side, this will mean a fall in the book value. If you want to do some more reading on this, then do check out some articles and materials that we have linked in the description section of this video. Specific to book value, do read up on the Graham number and also check out Joseph Piotrowski's work on the book to market ratio. The price earning multiple or PE ratio is the most popular valuation tool amongst investors. The ratio measures a company's current share price relative to its earnings per share, which is another way of saying how much do I need to pay for 1 rupee of profits. So for instance, if a company's share price is 200 rupees a share and it earned a net profit of 8 rupees a share, then the P ratio is 200 divided by 8, which comes to 25. Now, while a P ratio might seem very straightforward on the surface, the earnings number can be derived in a number of ways. Let's understand this better by examining it for Bata India. So the numerator is super clear. A share of Bata India currently trades at 2060 rupees, so that's our numerator. The denominator is where we plug in the earnings, which, believe it or not, can take 4 different derivations. The first is the last completed financial year's earning, which is something one would find in the annual report of the company's quarterly financial statements. In the case of Bata India, this number is negative 89 crores, which gives it an earnings per share of minus 6.95 rupees for FY 2021. So 2060 divided by minus 6.95 gives us a PE ratio of minus 296. A second way of applying earnings is by computing it on a 12-month trailing basis, that is, the net profits earned over the last 4 quarters. In the case of Bata India, the company earned a net profit of 23 crores over the last 4 quarters, which comes to an EPS of 1.8 rupees. So 2060 divided by 1.8 gives us a PE ratio of 1131. A third way is to use what the equity analysts tell us. You see, Bata India is covered by a number of analysts who process the information available and predict the net profits that the company can deliver over a quarter, an year, and over many years. Now, we examined a few of these reports, and the consensus seems to be that Bata India would close FY22 with an EPS of 17 rupees. This presents us with a PE ratio of 120. And this is typically what we would call a forward PE ratio, as it is a projection of where the earnings might be in the future. And the fourth approach to estimating earnings is by averaging it, which is done over the last, say, 4 to 5 years to remove any cyclicity or surprising incidents like the COVID pandemic. Now, Bata India has had a good run over many years, and its steady state earnings average comes to 21 rupees a share. So 2060 divided by 22 gives us a PE ratio of 93. From an investor's perspective, one needs to be aware of the type of PE ratio that is being put forward or discussed. Any misunderstanding on that part can make a big difference to your decisioning, as we saw in the case of Bata, where 4 different approaches gave us 4 drastically different PE ratios. On the positive side, the PE ratio is very simple to understand. It factors in profitability, which is a very apt basis for valuing most companies. And thirdly, the PE ratio is an excellent relative measure for comparing a company against its own historical records or with other companies within the same industry or sector. With regards to negatives, the biggest issue plaguing the PE ratio has to be the potential manipulation of earnings. In fact, we talked about this on our channel when we showed how companies hide expenses and boost their earnings using creative accounting techniques. If you haven't watched those 2 videos yet, then do add them to your watch list. A second issue with the PE ratio is that it sometimes hides a company's true worth. For example, Amazon for many years was one of those companies that never registered any earnings, which meant that purest value investors would almost always keep themselves away from this stock. But what Amazon did not show in terms of short-term profits, it more than compensated by investing those profits into future growth engines, which has done wonders for the company and its stock price. A third negative with the PE ratio is the misleading impression it gives, especially when it comes to cyclical stocks. For example, an examination of Hindalco's share price over the last 16 years shows us many periods of up cycles and down cycles. When we layer the PE ratio on top of this, one can clearly see the dichotomy between price and earnings, with the PE multiple ranging from as low as 3.7 to as high as 64 over this period of time. Now, what is typically seen during bull cycles is that company earnings accelerate at a much faster pace to price increases, which actually brings down the PE ratio. A rising yet relatively low PE acts as an incentive for retail investors to buy this supposedly cheap stocks without really understanding that the cycle is likely to taper in a few months. This results in these investors being stuck with a rather expensive stock with a high PE ratio, which more often than not converts into a negative return on investment. So one has to be cautious when using the price earning ratio, and one recommended reading here is Peter Lynn's PEG ratio, which measures the relationship between the PE ratio and the earnings growth, which can provide a more complete story to investors. The price to sales ratio measures a company's market capitalization relative to its top line revenue. A lot like what we saw with the P ratio, a company's revenue can be explained in multiple ways. Revenue can mean a completed financial year sales, or the last 4 quarters of sales, or projected sales over the next 4 quarters, or calculations can also use the average sales over many years to smoothen out the business cycles. Now, as expected, different sectors and industries have their own anchoring of what a good PS ratio should be, and in that context, the PS ratio becomes a relative measure. In fact, we found 2 companies which operate within the same energy sector with almost a similar market cap, but these 2 companies were at opposite ends of their price to sales ratio. So how can one usefully use the price to sales ratio? For one, this ratio can be very effective when evaluating growth stocks. See, by definition, a growth stock is one that shows a lot of promise on the sales and market share front, but is yet to show a profit or has minimal profits. The likes of Zomato, PB Fintech, Nykaa, and many more to come. So an understanding of their price to sales ratio can be a viable proxy until these companies start generating adequate profits, which might still be a few quarters away. Secondly, the price to sales ratio comes handy when examining companies in cyclical industries, especially in the years that they don't produce a profit. By using the PS ratio, investors can continue to grade these companies for their sales growth momentum, while their profits take a few more quarters to show comparable growth. To say the least, the price to sales ratio is not as subjective to manipulation as is the price to earnings ratio. But on the negative side, sales is a weak alternative to profits, and so the PS ratio will always be secondary to the P ratio for most companies and sectors. Another issue with the price to sales ratio is that it does not consider the level of debt that's there on the company's balance sheet. Now, why is that important? Let's understand this with a simple example. So we have 2 companies, and on the face of it, company B has the more attractive valuation from a price to sales perspective. Remember, lower the PS ratio, the better it is. But once we factor in the debt that company B holds, a more definitive picture starts to emerge. You see, what's happening here is that company B has been using loans to increase their marketing and distribution footprint, thereby generating cheap sales, for lack of a better word. This is something investors need to be watchful of, because a low price to sales ratio is often seen in companies that are saddled with debt, and some of them are also on the verge of bankruptcy. So in effect, while company B proudly wears the low PS ratio tag, there are problems elsewhere, in this case being the heavy debt that the company has taken up. If you want to read more about price to sales, then do check out the book What Works on Wall Street by James O'Shaughnessy, who is a staunch supporter of the price to sales ratio as the single best value factor. The fourth and final valuation ratio is the EV to EBITDA ratio, where EV stands for enterprise value and EBITDA is the company's earnings before interest, taxes, depreciation, and amortization. Now, the best way to understand this is to assume that you are a private buyer and are seeking to buy an entire company. So say you want to get into the tire business and are keen on buying JK Tyre and Industries Limited. Now, at the time of recording this video, JK Tyres had a market capitalization of 3,300 crores, which means you could buy 100% of the equity in that company for this amount. But then JK Tyres also holds a significant amount of debt, about 4,600 crores of it. So in essence, for you to indisputably own 100% of JK Tyres, you have to purchase 100% of the shares and will also have to extinguish 100% of the debt, which combined comes to an outlay of 7,980 crores. But wait, the company does have some money in the bank, which we loosely categorize as cash. It's not much, but for you, every penny counts, and this number comes to 174 crores, which can be deducted from your acquisition value. So for you to buy the entire company, you need to pay the market cap of 3,323 crores, plus the debt of 4,657 crores, and minus the cash that's already there of 174 crores, which gives you an enterprise value of 7,806 crores. So that's our numerator. And as far as the EBITDA is concerned, it's as simple as picking that number from the company's profit and loss statement, which for JK Tyre and Industries comes to 1,349 crores. So EV upon EBITDA gives us the EV EBITDA ratio, which calculates to 5.8 for JK Tyres. Now, as a general rule, a company with a low EV EBITDA multiple within its category peers implies a potentially undervalued company, with the reverse being true in case of high multiples. Over the years, this ratio has built up quite a following, and many successful investors point to the EV to EBITDA ratio as their favorite valuation metric. In terms of positives, the EV to EBITDA incorporates the company's capital structure in its entirety, that is, the equity part and also the debt part. The ratio uses the operating profits, which are core to the business and a lot more difficult to manipulate. And thirdly, the EV to EBITDA ratio has been proved across many studies to be the best long-term performing metric when stacked up against all other valuation ratios. On the negative side, the ratio ignores depreciation, which may not be the right approach for companies with large value of assets in their books. Nevertheless, for anyone interested in going deeper into the subject, I'll recommend you pick a copy of The Acquirer's Multiple by Tobias Carlyle. Additionally, we have added a few more reading and video material in the description, so don't forget to check that out. In this video, we looked at 4 popular valuation metrics. How are they calculated? Where can one find them? We also looked at some real-life examples before listing down some positives and negatives for each ratio. A majority of investors use at least one of these ratios, and a good number of them use it in a more composite way by combining 2 or more ratios. For instance, one may decide to focus on companies that have a price to book of less than 2 and a P ratio of less than 15. Similarly, someone else might use a EV to EBITDA of less than 10 as the primary filter, with a price to sales ratio of less than 5 added for good measure. Incidentally, there are many online screeners that can do this job for you, but be careful to not go crazy with these filters. I mean, yes, there will be that temptation to create a kick-ass multi-variable criteria, but the problem in doing that is that some of these metrics are going to be in and out of favor at different points in time. And if you use all of them at the time of screening, then A, you will find it difficult getting a workable list of companies, and B, the positive and negative effects might just counteract with each other and give you nothing tangible in the end. So be a little more pragmatic in approaching this, but there is no denying that these ratios and the proper understanding of these will make you a better investor. And with this, we come to the end of this video. I sincerely hope you learned something new today and will put this knowledge to good use. Please do like this video, subscribe to our channel, share this video, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.